Hello everybody, welcome back to another Trading Bootcamp series, and in this episode we will be looking at what are breaker blocks and what are mitigation blocks. These are one of the main things that I use for my sniper entries, which I don't use very often, but they are really powerful once you combine them with some confluences. Therefore, in this video I will just be teaching you the blocks, and that is the main point that you need to know if you want to snipe like a sniper. So let's start things off with what are blocks. So blocks are basically the last candle before an impulsive move up or down, as you can see right here, up or down. And that last candle creates a block. Now, the block is an area where price tends to manipulate the 50% of it. So you can see, I don't know if you can see really well, there's like a little dot right here in the middle. So yeah, once price touches that dot, it's basically what it wants to do, and it normally reaches that 50% of that candle. Now, it can be a candle or a series of candles. Therefore, blocks are basically supplies and demands. And yeah, it's basically supply and demand, but a little bit more complicated. We will look at some examples, but before that, let's look at the difference between what is a breaker block and what is a mitigation block. Now, breakers and mitigation blocks, they're all the same thing, basically. They're all blocks. They're all these blocks that you can see right here. As I mentioned, is the last candle before the impulsive move up or down. So these are all blocks, but these are two types of blocks that are very powerful. So let's start with the breaker block right here. So the breaker block is when it's, as the name suggests, you have a break below the low, basically a liquidity sweep, which after a market structure shift or a change in state of delivery, confirming that the trend is going to switch, this becomes your breaker block. It's not this, it's actually this becomes your breaker block. Now, how can you identify this? I will show you some examples as I mentioned before, but I will just give you some tips. So first things to identify the breaker block is you have to have a liquidity sweep. So instead of the mitigation block where you have a low and a higher low, for example, in this example, you have to have that low. This low has to be broken. And when that low is broken, it creates a liquidity sweep, which if the liquidity sweep is valid, if you saw in my liquidity sweep in my liquidity video, for a liquidity sweep to be valid, it has to have a market structure shift or a change in state of delivery on the opposite side to confirm the sweep and to confirm the change in the state of delivery, the change in trend, basically, which is what happens right here. So you got a low, then a lower high. As you can see, this high was lower than this high, and then from this high you have this impulsive move down, and the candle before that impulsive move down becomes our breaker block. Now, price could just do this, manipulate the 50% and then go back down. If that happens, that will be called an order block, but that is another thing for a future video, which is basically the normal block. So if that happens, it's another thing. But when price does sweep the liquidity and create that lower low and then push up and create the market structure shift or the change in state of delivery or even the break of structure and then manipulates back into that breaker block right here that was formed, we can actually take this for a trade, for a snipe. Now, let me recap a little bit on this. So you have lower high from right here, high, lower high, and then you have low, lower low. This low broke this low, creating a liquidity sweep, therefore the breaker, because it broke this low, and then this low exploded up, and when it exploded up, it manipulated the 50% of this candle, of this last candle or this last series of candles from the impulsive move down, and then to target the buy side liquidity, which was formed from the previous impulsive move. It's that simple. Now, of course, let me get my drawing. So, of course, forget about this. So, of course, this could happen where you have this, and then this, and then this, the same thing, but I manipulated towards this block right here. And that's why our stop loss, it's that low. It's at the low of the liquidity sweep, because although we have the market structure shift and the change into the delivery, we cannot confirm it's valid just because of those two, because A, there is no other confluences that we have unless this is an SMT, which is another thing for another video, because if it's not, then, oh well, it doesn't really matter. Therefore, our stop loss has to be this big, because if price decides to pull back beyond that 50% of the breaker, it's actually called, this is going to be actually called an order block, but as I mentioned, is another thing for a future video. Therefore, it's that simple, right? Now, mitigation blocks are basically the same thing, but as you can see, I'm going to show you so you can compare the images. I don't know if it's good. I think it's good. So mitigation block is basically the same thing as the breaker block, but the mitigation does not create this, does not sweep out this low. This does not happen on the mitigation block. It actually just doesn't sweep and just creates the higher low. So let's recap on the mitigation. So you have high, lower high, and then low, higher low. So this low did not break this low. So this low, let me show you. So this low did not break this low, aka a liquidity sweep. It did not do that. It otherwise created this higher low. And then that higher low exploded impulsive up towards to creating that market structure shift and the changes to delivery. And it's the same thing as the same principle as here. You have a candle or a series of candles before that impulsive move down that created the higher low and not the breaker, And then it pushed back up price, creating the market structure shift and the changes to delivery to then manipulate to the 50% and then go target the buy side liquidity. Now, same thing applies to the mitigation block as the breaker block. As I mentioned before, in the breaker block, price could just go down and sweep and tap into this order block, this block we call it. Price could just manipulate this block and then go back up. Therefore, that's why we have our stop loss right here and not right here. People who actually trade like this are actually high risk traders, which is not a thing I like, because I like to have my strategies good and based. Now, let's look at some examples right here in the charts. So let's start off with what is a block. Well, let me actually, all right. So as you can see right here, the block. Let me just rearrange things, because, yeah, as you can see, these happen very frequently, and we have a mitigation block example right here. But the block, as you can see, last candle before the impulsive move up, so you got this candle, and then you got this impulsive move up, price then retraced. It unfortunately did not retrace the 50% of this, and then, boom. This was actually a really good explosion. Damn. Well, this is not that common. This explosion is really, really good. So, yeah, this is the block. We call it block, can be called order block, but that is, as I mentioned, for a future video. Now, let me actually take this out. All right. So now this is the mitigation block setup. This is called the mitigation block setup. Now, what do you have right here? This same thing. It's actually the same thing that happened right here. Like, look, take a second to analyze this. Even take a screenshot, do whatever. Look at this. All right, I'll give you like 3 seconds. 1, 2, 3. And now look at this. Can you compare it? It's actually like the same thing. So you can see this works really well, and it actually happens very frequently, very often in the markets. So you have, what do you have? Buy side liquidity. So this high impulsive move up. You got this I tend to call it manipulation because I'm a power 3-day trader. We can just be calling this the pullback, or what is even this? Just the impulsive move down. There's no pullback to nothing whatsoever. So this is just the move down, all right, to create this range. So this move down created buy side liquidity right here and sell side liquidity right here, which is our low for this trade, right? And then price, what do we have right here? We got this impulsive move up right after. And then price, as you can see right here, did not sweep this low. So in the breaker block, what would happen if this were a breaker block? The breaker would have just swept and did the same thing. But now, since this is the mitigation, price did not actually sweep this low and actually created this higher low. And then that higher low got impulsed back up. And what is this? So you got the last candle before the impulsive move down. This is December PA, so this is the best impulsive move that you can ever have. So you have the mitigation block right here. The last candle before the impulsive move down. In this example, if this were a bearish example, it will be the bullish. But since this is a bullish example, it is the bearish. It's basically vice versa. So the last candle before the impulsive move down, you got a break of that block, and then you got retest of the 50% to then target the buy side liquidity for a nice 1 to 2. So yeah, it's that simple. You enter right here, and this is basically a snipe. Now, people often trade like this, put stops at the candle bodies for a higher RR. Just as I mentioned, I don't like to do that because I'm not a high risk trader, and I just did something wrong. All right, it's good like this, because I'm not a high risk trader, and I like to take trades that I'm not 100% certain that are going to happen. Therefore, I put it in the low because this could happen and also this could happen. So mitigation blocks are strong, but I prefer order blocks or just regular blocks, which is, as I mentioned, and I will keep mentioning them, I will explain in a future episode. Now let's look into the breaker block. Breaker block, it's one of my favorites. Before the order block. The order block is actually my favorite. So what do you have right here? You got this impulsive move down to create the range, to create that certain range for price to trade into, right? So you got the range set up, and then boom. What do you have right here? Tell me. So interact with this video with me so you can say as I explain it. So what is this right here? Low. Good. And then you have this December PA, it is what it is. So you got this basic impulsion / accumulation move. And then what is this? Last candle before the real impulsive move down, right? Look, one candle, and then, let me put it right here. One candle, and then impulsive move down. And this impulsive move down, it's not the same thing as the mitigation block because this impulsive move actually swept this low. So this low is actually going to be a high resistance liquidity low, which is a thing I mentioned in my liquidity video. And then after that, you have the change in state of delivery and the market short shift off of this candle body closure above the high of the of this block, creating the breaker block, right? And then you got the changes to delivery, the market short shift to confirm everything, and then you got the manipulation to the 50%, and as you can see, to the tick to then snipe this. So yeah, pretty basic concept, and I don't think I have mentioned this, but just to make things clear and just for me not to get a little bit confused, I will mention again if I didn't. So the breaker block to be formed, you have to have a candle body closure above the breaker high. So what does this mean? So let's go back in here. So the blocks are this, right? Now the breaker block is when price closes like this. So basically price closed below, in this example, it closes below the breaker block or the mitigation block, 50% move down. That's the breaker or the mitigation depending on the situations that we are presented with. And yeah, that's basically everything that you need to know. I'm not going to overcomplicate this video. Pretty basic stuff you need to know. And yeah, I have, just to finish things up, I am working on my Power 3 encyclopedia. It's I would give it like 3 to 2 more weeks, and then I will post it on my Instagram and on my YouTube description. I will keep posting that as I post YouTube videos, so you can stay in tune with my strategy and what I trade with. And yeah, that's what I wanted to say. And have a blessed Christmas and a blessed night. May God be with you all.